Welcome to the channel and thank you for choosing to watch this video. My name is Jonathan and I work in the offshore global business industry. In this video, we will cover offshore companies established in foreign jurisdictions. First, we will recap what was talked about in the previous two videos concerning the terms offshore and international financial centers. Second, we will go over the classification and characteristics of offshore companies. Third, we will cover the types of offshoring activities undertaken by such companies. Fourth, we will dive into the advantages and disadvantages of setting up offshore companies and legal entities. And finally, we shall glance into the key takeaways surrounding the registration of such companies. I hope you enjoyed this video and wish you a reflective and insightful viewing. Offshore or offshoring pertains to a location situated beyond one's native country, often employed in the context of banking and finance to characterize regions with regulations divergent from the home country. Typically found in island nations, offshore locations are chosen by individuals or entities to establish corporations, investments, and deposits. Companies and individuals, particularly those with substantial wealth, may opt for offshore arrangements to benefit from advantageous conditions such as tax efficiency, lenient regulations, or asset safeguarding. While offshore institutions can be utilized for unauthorized activities, they are perfectly legal to establish. The term offshore encompasses various foreign entities, accounts, or financial services. To meet the offshore criteria, the activity must be conducted in a country other than the individual's or company's home nation, where their respective taxes are being paid. Consequently, even though the person or company may be headquartered in one country, the operational activities occur elsewhere. In essence, going offshore involves providing services to non-residents of that country or jurisdiction where it is established and registered. A hypothetical example of a top-to-bottom offshore structure would be where the principal, economic contributor, or ultimate beneficial owner, as they are sometimes referred to, would be a family originating from South Africa, possessing extensive experience within the precious stones market. You can guess which one I'm referring to. Having legally immigrated to the United States from South Africa, where they are now resident for tax purposes. Here, a brother and a sister would each set up a discretionary trust through a trustee based out in Switzerland, but with a trust governing law that could essentially be in another jurisdiction favoring trust laws, of course. Those two trusts would then hold all the shares and voting rights in two separate offshore companies incorporated in the British Virgin Islands. Those BVI companies would then in turn hold 50% of the shares and voting rights in a single subsidiary or offshore company in Mauritius, which would typically be categorized and labeled as a Global Business Corporation or GBC. That Mauritian GBC, licensed by the Financial Services Commission of Mauritius as a trading and distributing company, would operate solely out of Mauritius in South Africa, where it would buy and sell precious stones and ship them for quality control and distribution in Antwerp in Belgium, which is the known capital since the mid-1400s for superior craftsmanship and trusted with absolute confidence by both traders and consumers. The animation you just saw can be quite tricky to put down on paper if you don't possess the industry know-how. So to make it make sense, this is what the structure chart would look like on paper. You will see that I put country flags on my structure chart in relation to each party involved, and I do so in my actual line of work on a daily basis, even concerning where the goods or services are being sourced from and to. This is done for a very specific reason. You will remember from my previous videos on the Financial Action Task Force and European Union Black and Grey lists that these are updated multiple times a year, meaning countries are susceptible to being added or removed from such lists. When inserting flags in structure charts, it now only takes a few seconds to identify which parties require the application of an enhanced due diligence process in terms of requesting additional Know Your Customer or customer due diligence documents. This will also make it easier for the compliance department, in collaboration with the senior management of management companies, to establish if the professional relationship with the client is worth maintaining. This is on a risk-based approach, which is the guiding principle behind the AML and CFT legislation in Mauritius. Lastly, in this particular hypothetical example, because the principals and UBOs are originally from South Africa, and the fact that the GBC is dealing in precious stones, once again out of South Africa, which is currently on the FATF grey list or the list of jurisdictions under increased monitoring for deficiencies in its anti-money laundering and countering the financing of terrorism legislation, such structure and activity would be classified as medium to high risk from a risk appetite perspective. While offshore can broadly indicate any foreign location encompassing countries, territories, or jurisdictions, it has become predominantly associated with specific regions favored for offshore business activities. These include Caribbean island nations like the British Virgin Islands, Bermuda, the Bahamas, the Cayman Islands, the Channel Islands of Jersey and Guernsey, and the Indian Ocean islands of Mauritius and the Seychelles, to name just a few popular ones. Additionally, landlocked countries such as Switzerland, Ireland, and Belize are also recognized as popular offshore financial centers. The terms offshore company or offshore corporation are employed in at least two distinct manners. Firstly, it may denote a company, group, or occasionally a division involved in offshoring of business processes. Alternatively, it can refer to international business companies or legal entities established under the laws of a jurisdiction that restricts local economic activities. In the case of Mauritius, it would be the GBC. In historical terms, offshore companies were generally categorized into two groups. On one hand, there were companies that received statutory tax exemptions or 0% tax rates in their registered jurisdictions, provided they refrained from conducting business with residents of that jurisdictions. These entities were commonly known as international business companies or IBCs and gained prominence, initially pioneered by the British Virgin Islands but later emulated globally. However, around the early 2000s, the OECD initiated a global effort to prevent the ring-fencing of taxation through this approach. Consequently, several leading jurisdictions, including the British Virgin Islands and Gibraltar, repealed the legislation governing IBCs. Apart from IBCs, some countries have tax regimes that achieve a similar outcome. As long as a company conducts its activities overseas and does not repatriate profits, it remains exempt from taxation in its home jurisdiction. In cases where the home jurisdiction is considered offshore, these companies are commonly referred to as offshore companies. Mauritius is an example of such a jurisdiction, imposing a 15% corporate tax rate, which can potentially be reduced to a maximum of 3% or even 0%, subject to meeting specific criteria and exemptions. Further details will be discussed in another video on this topic. While offshore companies may exhibit variations based on the corporate laws of the respective jurisdiction, they generally share several core characteristics. For one, they typically avoid substantial taxation in their home jurisdiction. Second, the corporate framework is structured to facilitate business flexibility. Third, oversight of corporate activities tends to be less stringent than in developed countries. However, the absence of taxation or stringent regulation in the home jurisdiction doesn't exempt the company from taxation or regulation abroad. For instance, Michael Kors Holdings Limited is registered in the British Virgin Islands, but is publicly traded on the New York Stock Exchange, making it subject to both U.S. taxation and financial regulations imposed by the U.S. Securities and Exchange Commission. Another prevalent feature of offshore companies is the restricted accessibility of information to the public, and this varies across jurisdictions. At one extreme, in locations like the Cayman Islands and Delaware in the United States, there is minimal publicly disclosed information. Conversely, at the opposite end, companies in Hong Kong are required to submit annual returns containing details about the directors, shareholders, and annual accounts. Nevertheless, even in jurisdictions where public access to information is relatively limited, such as Mauritius, most places have legal provisions enabling law enforcement authorities, whether local or international, to obtain pertinent information, and in certain instances, private individuals may also have such access. There are several types of offshoring activities, which include the three prominent ones being business, investing, and banking. Offshoring business, synonymous with outsourcing in business, involves relocating specific functions like manufacturing or call centers to a foreign country for favorable conditions, such as lower wages or relaxed regulations, leading to substantial cost savings. Major international corporations like Apple and Microsoft may also retain profits in offshore accounts in low-tax countries, especially when their sales are significant overseas. Offshore investing involves scenarios where investors reside outside the nation of their investment. Typically utilized by high net worth individuals, managing offshore accounts can be costly, necessitating the establishment of accounts in the desired investment nation. Offshore accounts, often registered under a corporate entity like a holding company or a limited liability company, offer benefits such as tax advantages, asset protection, and privacy. Despite these advantages, offshore investing is associated with high expenses and heightened global regulatory scrutiny faced by offshore jurisdictions and accounts. This level of complexity may render offshore investing impractical for most investors. Additionally, regulators and tax authorities closely monitor offshore investors to ensure compliance with tax obligations. Finally, offshore banking involves safeguarding assets in foreign financial institutions, subject to limitations imposed by the customer's home country laws, similar to offshore investing. It serves as a strategy to avoid unfavorable conditions tied to keeping funds in domestic banks, often motivated by a desire to minimize tax obligations. The use of offshore accounts held by the offshore companies also adds a layer of difficulty for authorities attempting to seize assets. For individuals and businesses engaged in international activities, holding funds in a foreign currency facilitates easier access to global transactions, eliminating the need to constantly account for fluctuating exchange rates. Diversifying one's portfolio by investing in an offshore financial center can be beneficial. Opting for international investments across various asset classes and currencies helps mitigate overall investment risk. Depending on the jurisdiction where one holds his or her assets, may result in a favorable tax environment. For example, the Cayman Islands, known for not imposing taxes on income, dividends, or capital gains, allows for investors to retain a larger portion of their earnings. Additionally, offshore financial centers often benefit from stable economic and political systems, providing a certain level of protection for one's assets. The foreign location also adds a layer of difficulty for creditors attempting to seize assets. Maintaining offshore accounts exposes individuals to heightened scrutiny, often viewed as a method to evade tax obligations. Failing to disclose holdings to the relevant tax authorities, such as the Internal Revenue Service in the United States, can lead to serious consequences. Despite certain jurisdictions offering complete confidentiality to account holders, an increasing number of countries are adopting greater transparency with tax authorities. Non-disclosure of holdings may result in legal consequences. When considering international investments, it is crucial to conduct thorough due diligence, similar to the due diligence exercised when engaging in domestic transactions. Selecting a reputable broker or investment professional is imperative to ensure proper handling of one's funds. Neglecting this step poses a potential risk to one's investments. The term offshore encompasses any business activity conducted beyond the confines of an entity's home base. This can include operations involving foreign banks, corporations, investments, and deposits. Legitimate reasons for a company to establish an offshore presence may involve tax avoidance strategies or the pursuit of more lenient regulatory environments. On the flip side, offshore financial institutions have been susceptible to misuse for illicit purposes, like money laundering and tax evasion. As global scrutiny intensifies, there is a growing trend toward increased reporting of foreign accounts to international tax authorities. This evolving landscape underscores the dual nature of offshore activities, serving both legitimate business interests and posing challenges related to financial integrity and legal compliance. Thank you very much for watching this video until the end. This is hugely appreciated by me, and I hope it provided you with valuable information, insights, and key takeaways. As always, I will be posting frequent and insightful content, so feel free to come back to the channel for more videos concerning the offshore global and financial services industries. Stay safe and healthy, guys. I'll see you in the next one. Cheers.